investments, whether we like it or not, they are highly political. They have real life impact. And this esoteric approach of like just looking at numbers, graphs, and et cetera is really one-sided. My mother got sick and passed away, so I took a break. I honestly didn't know what I was going to do next. Sometimes it's good to be lost. Talk to everyone in your network, or even just look at the clouds. I'm very mission-driven. I have all these different aspirations around impact investing, but the learning was I need to be in a fully mission-aligned firm. I looked around who in the investment space could be a home for me, which is really holistically dedicated to impact. And Veris has been since 2007. It was one of the first impact-only wealth management firms in the world, not just in the United States. A firm that in its core believes that sustainable finance should be core to your offering, and that's all you do. We only manage about $2.3 billion under management. There's about 300 clients, and we're moving more and more to institutional clients. I would say it's our holistic approach that is our secret sauce and the deep thematic expertise. In our view, there is no need for the trade-off. And that's why for us, it's important to be seen and understood as an investment shop, having excellent financial acumen so that we're looking for best-in-class investments, both from a financial return and an impact return.
So what was your secret to that extraordinary growth? Scaling anything tenfold is remarkable. How did you do that?
The guiding principle here is Delphi's know thyself. We really need in-depth discovery of the client. So I focused on...
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Stephanie, it's nice to meet you. Thanks for joining me today.
It's great to be here. Thank you.
I always start these conversations by understanding a bit about your background. You grew up in France, but you speak English with what sounds like an American accent to me. So there's obviously a story there. And I'm curious to know, what was your childhood like growing up in France? Who were your parents? What did they do? And looking now, what experiences do you think shaped you most profoundly? Because I truly believe that our early experiences define so much of our journey.
So I'm French and American. I'm born in the United States. My father's American. My mother was French. And I grew up in an international school just outside of Paris, called the Lycée International de Saint-Germain-en-Laye. That was really formative. My parents were both doctors. My mom was an anesthesiologist and a pain physician, and my father an ophthalmologist. But they both did a lot of humanitarian work, and that really, I think, opened my eyes to international development, that then opened my eyes to the impact investing world that I built my career in. Growing up in France was amazing. I mean, it was initially the Mitterrand years, I would say rather stable socialist environment, idealist, and a much more simple world than I think what France is now, with the dream of Europe. So when I was in high school, everybody was using the Erasmus program to go study in the UK. In my case, it was between Germany and the UK. This is pre-Euro. So a lot of excitement around what Europe could become with England in it. There was no such, dream, thought process of Europe without the UK. It was a wonderful childhood and experience growing up in an international community outside of Paris.
Now, I happen to be aware that you are an accomplished French cuisine chef and that you like to cook for guests. So who is the one who taught you how to cook like that?
My mother, when she retired from medicine, she took a lot of classes in Paris, and she was already an amazing chef. To complicate matters culturally, she is what is called Pied Noir. So she was from Algeria. Her influences on the culinary side were Algerian French, and then she learned a lot of traditional French cuisine. So I was exposed to those, I'd say those influences. But I think it's more the breaking bread and, one of my favorite films is Babbitt's Feast, but just the concept of bringing peace amongst neighbors or different people who might have beefs against each other, but by breaking bread and eating good food, you can agree to disagree and you can build communities. It's more being at the table together that I like than the food itself. The food is a means to an end.
What is your favorite French dish you like to prepare for your guests?
Duck, I would say. Pretty traditional, but yeah.
Let's dig into your education a bit. You already mentioned you went to the Lycée International de Saint-Germain-en-Laye, and you got your French baccalaureate with the international option there in maths and in economics. Was that a deliberate choice or was it more circumstantial? And describe what that educational environment was like at the lycée.
The reason my parents wanted me to do this is that it was the only degree at the high school level that would prove bilingualism. So it's different than the IB, the OI, whatever. It's just, there's all these international accreditations and so on. But the point is, my parents wanted me to go to a very good school. I remember even just getting in elementary, went through all these terrifying interviews where you wonder whether you're going to jail if you don't make it in. You don't understand why people are asking you all these questions. But basically, it was the rigor, extremely hard work. I mean, we're talking like 60 to 70 hours of studying in high school and a high caliber of teachers who could have been college professors. So it was a great experience.
In 1995, there's this interesting pivot, and you head to the University of Bristol to study politics and philosophy. That's a shift both geographically and academically. What drove that decision and why specifically the combination politics and philosophy? Why at Bristol? Or did you just want to get in shape without actually going to the gym there with all the hills they have?
I didn't want to stay in France. The choices were the Grandes Écoles or the Prépa. Again, it's like the Grandes Écoles, which was super competitive and so on, and not really, the kind of ideologically and in terms of topics, not what I was interested in. Or the big universities that are, for our listeners who don't know, industrial style French university. So, we're talking huge amphitheaters, very little personal attention from lecturers or professors. And I got into multiple schools, one, at UCL to study in Germany. That was in London. And then I looked at Bristol, which I thought was fascinating because it is still a very good college, but super quaint. It almost looked like an American campus, outside of the hills, as you mentioned. So these were like merchant mansions turned into departments. So I thought it was very beautiful. And I wanted to study either politics and economics or philosophy and politics. So I went in and I studied all three, and then I had to choose. And I actually was way more interested in philosophy than I was in economics. I just thought the questions were just so fundamental. The economic piece I felt like I could learn at any point in my life, but the philosophy was not something I could learn under this level of, thought provocation. And at that time of life, you're also asking yourself big questions. So it was very appropriate. And I generally was interested in democracy, political theory. So the Venn diagram of politics and philosophy made sense. And it was fun. Bristol in those years was music, but for the music perspective, Portishead and a lot of really good music came from Bristol. So it was like culturally fascinating to be there. Massive Attack and so on. Whomever remembers that. It was fun.
After graduating from Bristol, then you went directly to the London School of Economics for your master's in comparative government. So what was going on in your mind at that point, and what were you looking for to get out of that line of study?
Well, so it was a continuation of politics and philosophy. It's basically political theory. 3 years felt short because the English system is unlike the US system. The undergrads are usually 3 years. And so I wanted to continue looking at democratization and political theory. Of course, London was a hell of a lot more fun than Bristol, but it was just really amazing place to live. And I actually learned a lot there about democratization and And my passion became, if it's true that peace and stability comes from democracies, then how do you build democracies? It's the big question. And I thought I could get into the work of democratization, being a consultant to different governments that were in transition. Remember also in the 90s, this was after the fall of the wall, and looking at all these countries, transitioning to being democratic after decades of control, under the Soviet bloc. And it was just that my passion at the time was like, well, what becomes of these countries, while also looking at the wave of decolonization and many countries having elections for the first time. And of course, some horrible things occurring like in Rwanda and in the 90s as well. So for me, democratization was really the big theme of that decade.
Your first professional jobs out of school was first a role at UNESCO in Paris, but you were working on education in Africa, which was then followed by a role at the World Bank as a consultant in Washington, D.C. and Djibouti. You've mentioned previously that the reality of your experience with these international development organizations played out quite a bit differently from what you initially expected. So tell me about those experiences and the gaps between what you expected and what you found, and how that changed your perspective.
At that stage, I couldn't, because I wasn't a PhD and I wasn't an advisor, I couldn't quite get a job in the field of democratization. So I basically found, through some of my contacts in Paris, a position in UNESCO in education and education development. I thought maybe that could be my career, just exploring what education, the impact of education could be. Also as a, core tenet for an informed society and citizens, for this concept always of democratization. That was an internship. And then I met people who recommended me to go, interview with other former colleagues in education at the World Bank. And then I worked there for a year. But I have to say it is, massive. When you're young, idealistic and so on, it's like it's a soul killer, because the World Bank is extremely administrative. You are a cog in the wheel as an analyst. And then you realize that once you travel for the bank, as I did in the Horn of Africa, a lot of the work has nothing to do with need of enrollment, poverty, etc. I mean, it has some to do with need, but it is completely political. It's what arrangements do countries have, for everything, military and economic agreements, bilateral or multilateral diplomacy. And so I realized the machine moved extremely slow, and I'm very impatient. And I thought, oh, great. So I'm working on a financing mechanism to build 60 plus or whatever classrooms in Africa that will be built in 9 years. So I'm like, okay, by then, who knows what's going to happen? And so I started looking at what kind of impact I could have that was shorter term, like what more entrepreneurial, more dynamic. And that's how I realized, the big multilaterals are too political for my taste. What can I do that is shorter term, higher impact, more entrepreneurial? And that was microfinance.
After the World Bank, you joined an organization called ACDI/VOCA, Working in Microfinance. I love all these acronyms, but for those listening who don't know what ACDI/VOCA is, could you explain what it is? And they must have a way to pronounce that.
ACDI VOCA, it still exists today, and I feel bad for them because they're a massive USAID contractor, so God knows what's going on there now. It's the merger of two different organizations that were focused initially around volunteering for agricultural development. That's how it came about. And also leveraging the Farm Bill in the United States to support farmers abroad. But they pivoted into microfinance. And so that's where I really got my firsthand on the ground experience with microfinance institutions. I couldn't find a job in Francophone Africa. So I took what I could, and I was thrown into Russia and Central Asia, where I started studying Russian while I was there.
How did that go?
Oh, I loved it, especially the Central Asian republics. I worked in Kazakhstan and Uzbekistan, and it was a completely different world. Before, when you looked at a map, it was this massive region called the USSR. And once all these republics came to the fore as independent, then very few people knew of Turkmenistan or knew of Uzbekistan or Kazakhstan and the cultural differences. I mean, these countries speak Turkic languages. They're Muslim, but there's been so much influx of forced migration from the rest of the USSR. So there were Germans there. There were people from all regions of Russia. I mean, it was just absolutely fascinating, the combination of Islam and the Soviet culture and a language where usually I can cheat my way in understanding certain languages, but I have no background in Turkish. And so I couldn't cheat my way into understanding Uzbek. So that's why I had to study Russian, which I think is a beautiful language. So that was fun.
What did that experience teach you about yourself?
That the world is really wide and that all the buckets I've had culturally or in my head about religion, history, culture, language, etc., was extremely simplistic. I had some colleagues I met who were Muslim. I mean, also ethnically, these are different types of nations within Uzbekistan. Very different ethnically than in Tajikistan, where I went later, but who did drink alcohol. And I lived for a month by myself in Uzbekistan working on a project. And it was during Ramadan. And I had no idea that in the evening, the children there would bang on your door and ask for candy. And so there was, every evening I was like, what's happening? Why all this noise? But just culturally, I was constantly being challenged. I just assumed I knew what was going on and I didn't. It was phenomenal.
After that fieldwork, you made a significant investment in yourself by pursuing a master's of public administration degree with a focus on finance, trade, and macroeconomics. You did this at Harvard Kennedy School, and I think the time frame was around 2003 to 2005. That sounds like a substantial pivot point. What were you hoping to gain with that course of study? Why Harvard specifically, and how did that experience transform your perspective?
Well, I love studying, but I wanted to further understand the world we lived in, to understand where my place was in terms of having greater impact. I had all these questions. I mean, basically my essays to Harvard were just a litany of questions that were unanswered. When I was in Central Asia, I remembered seeing a lot of U.S. troops stay in some of the same hotels that I stayed at. And I would talk a little bit to the military and why are they here? And then I realized there were deals between some of these Asian Central republics and the United States and Russia pertaining to Afghanistan, which was just down further south. Just a lot of geopolitics, which were not necessarily covered in the news. There were no journalists in Tashkent and in Samarkand, wherever, all these big cities in Central Asia that I was visiting. But I could see I was there because it was USAID funded. And then I'm like, why is this region being so much funded by the US government? And why am I here on a microfinance project with all these military in the same hotel? And, you start asking questions about the why of things. And I just wanted to take a pause and have a broader view, also to develop my career. And the Kennedy School is an amazing school for public policy, for international development. I also met my husband there, which was, a double whammy. But it helped me think through, how do I get into finance and with a socially responsible mindset. I'm so glad I did. It really changed my life.
You came out of Harvard and you went into investment banking at UBS, working on emerging market finance. Now, that's quite a shift from what you were doing before. Tell me what you were thinking at the time, and what was it like working on sovereign issuances in places like Israel and Poland and Azerbaijan and Romania? And what did that experience reveal to you about the financial system and your place in it?
Actually, I started first in New York. It was very typical for public policy grads like me to get into public finance, but I missed the international angle. So I transferred internally to London to do the sovereign issuances. The reason was a very simple one. Harvard is an amazing place, but it saddles you with significant debt. And I also realized that if I wanted, by the time I graduated from Harvard, I knew I wanted the interplay of finance and an impact. And I had a lot of field experience and I knew microfinance, but I didn't have the kind of chops of traditional financial background. And I realized when I was approaching different firms doing interesting work, they're like, yeah, you've never really worked in a financial shop. And you chose not to do an MBA. So, I was constantly going to like the political theory stuff. And so I realized I need to bite the bullet and actually work for a financial institution to get a good understanding. The corporate and sovereign issuance desk was fascinating as well, trying to understand, sovereign risk. But it was, everywhere you go, everything is hyper political, relationship based. And it was very interesting to see, especially how the bankers operated. This wasn't the place for me because it was not impact oriented. It was just traditional. How do we charge the greatest fees? It was traditional bottom line driven, and the bonus is not what motivates me.
But a good training ground in terms of a financial foundation to build on. But then came a brief stint at Planet Finance in 2007. What's the elevator pitch for Planet Finance and what were you doing there? I think it was microfinance related again.
I was trying to get back into the microfinance world by staying in Europe mostly, but I was living between New York, Europe, and then doing a lot of, in this case, I was doing debt origination. So the theme in all of this is fixed income, whether it was at UBS or at Planet Finance or later, that was really my strength, and just originating loans to microfinance institutions.
That didn't last too long. And then you went to Omidyar Network, which is here Omidyar's and his foundation. This seems pivotal in your journey. Talk about what is Omidyar Network and then what was your role and what you were doing there.
So Pierre Omidyar was the founder of eBay. He's a billionaire who was one of the first movers in the impact investing industry. So he understood, I think before a lot of ultra high net worth individuals, that you could do good and do well at the same time, and he would put his money to work for it. So not the traditional foundation. And my job was to be an investment professional and then a principal in the organization. And I was first hired for my expertise around microfinance.
How did you land that job?
I had multiple people tell me about it. When I was at Planet Finance, we already knew of I already heard of who was investing in microfinance. Pierre had a fund at Tufts University, which he had already $100 million fund, and he was going bigger with his own family office. So multiple touch points, and then I contacted them and, they brought me in and we started talking. He really is an unbelievable mind, just think in an unconstrained way. So when others were doing traditional foundation work, he was looking at being a nonprofit, but also doing impact work and philanthropic work through a for-profit. So for him, the tax status, the legal structure, and the kind of way, the traditional way of thinking of buckets would explode, because under him, it was much more about the impact that you wanted to have than it was how you went about it. So he was very different, very much ahead of the game.
I read that you've said that your time at Omidyar Network is where you realize that every investment either promotes or detracts from an asset owner's beliefs. Now, that sounds like a profound realization. And if that's true, how did that moment change your approach to your work and perhaps even your life?
The big thing, because he touched different themes. So, you walk in there thinking, okay, my mission is to try to deploy assets into small loans for poor entrepreneurs. But then he's interested in tech for good and education and, you name it, all these different themes. And so I'm starting to realize, wait a second, every industry, every investment is either furthering his personal mission or, maybe he's net neutral or detracts from it. And I started having a very different perspective on investing in general. In his case, we only touched just private investments. So it was venture, private equity, PRIs, MRIs, grants, recoverable grants, et cetera. And then he had a different team that would do in all different asset classes and public equities. We didn't touch that from where I was for those 5 years. I started just seeing that, investments are very, whether we like it or not, they are highly political. They have real life impact. And this esoteric approach of just looking at numbers, graphs, and et cetera is really one-sided. And then I realized it's not just for Pierre, it's for any kind of investment, for any kind of asset owner, ultra high net worth or not. So, I mean, I'm summarizing 5 years of work and reflection. But then I also worked in land rights for him, looking at property rights for the poor. And those years were just incredible.
Then in 2013, you moved to Toniic, and that's spelled Toniic. And your Toniic chapter is fascinating. You grew membership tenfold as the CEO there. So first, help us understand what exactly is Toniic and how does its business model work and what problem is it solving in the sustainable investment ecosystem?
Once I realized, okay, so I'm working for a billionaire. Not everybody can be a billionaire to do this impact. I thought, well, why not help other investors? So of a certain wealth. So it was, I think, 5 million and above in assets to do the same in all asset classes. And so it was a hybrid it still is a nonprofit and for-profit. And it's a global community of impact investors, basically learning from each other, it's peer learning around investing in all asset classes for impact around different themes. So a lot of it was bringing in experts, showing deal flow, having peers present their own portfolio in all asset classes and see how they're trying to align that with their mission and their values. And also growing it, and that was the hard part, on a shoestring budget, in India and Mexico. And, the easier part was Monaco and Amsterdam, where there was a lot of movement already, in London and so on. So the European growth piece was easier, and the US piece in Canada was already much, much easier. But doing Brazil or Mexico or India, and there's a different way of talking about wealth in certain cultures. I mean, you don't just say, well, I have $100 million, and it's just culturally very awkward to have peer sharing in areas where you don't talk about money. You don't flatter yourself for having made big grants or big bets. That was fascinating. But the point was to try to build a movement of impact investing, that you could invest in all asset classes, in different themes, furthering your mission, and also make money as a result.
So what was your secret to driving that extraordinary growth? Because scaling anything tenfold is remarkable. How did you do that?
I think the issue at the time is that you had great momentum. Families were interested, but they didn't have an infrastructure that felt safe to share information. So I focused on safety, so that a lot of the membership value was very clear. So when you joined Toniic, you knew what the promise was, what the commitment was on the part of the company. You knew that the structure was strong. So we built, a non-porous social network. People of this wealth, you can't just go out and say, let's create a LinkedIn group or whatever. We built things that were safe, that were, high quality. The value proposition was very clear. And I also was very big on trying to create the domino effect. So if you know that so-and-so in Berlin is going to join, you might want to join as well. So it was leveraging very important families who are willing to share their name as references to really build this network. So, I mean, it's not like Toniic was known like a YPO network or a Tiger 21 or whatever. So you really had to use members as ambassadors. And that's one of many things. And I also recruited some fabulous people in the young, hungry people in the impact investing space who wanted to build a movement. So super high energy group.
Then came the move from Toniic to become the head of impact investment at Tiedemann Advisors. Now, I'm always curious about transitions. How did the opportunity at Tiedemann materialize? And then maybe you can tell us what Tiedemann is known for in the wealth management world, because this is where you entered that world. And what was the learning curve like when you first dove deep into sustainable wealth management? Were there any unexpected challenges or surprises for you there?
I didn't actually join Tiedemann. And to be candid, I don't think I would have joined it. What happened was I joined a firm called Threshold Group, which was George Russell's multifamily office. So George Russell founded the Frank Russell Company and the Russell Index business. I'm sure you know the Russell 3000 and so on. So an ultra high net worth family based out of Seattle, lovely people. And they had a boutique multifamily office. And I joined that because I was there to build the impact offering. And the reason for that was after over 3 years of working at Toniic, I was helping all these families do impact in all asset classes. And I thought, well, I missed the investment side. I was really a coordinator, a movement builder, I would say a community builder than anything else. But really in my core, I'm more intellectually driven by the investment discipline. And so I thought, well, if I can build a platform for impact investing in all asset classes, in a family office where I feel aligned with the family and very kind people, I thought, and great clients, this could be wonderful. So I joined that and I opened the San Francisco office and I started leveraging all my knowledge from Omidyar and my field work and so on into serving clients and building a platform. But what I didn't foresee is that they would want to sell. The family needed to, there's a whole slew of reasons for this, to a much larger registered investment advisor. And that was Tiedemann. So I just helped with the transition for about a year, but I knew it wasn't a fit because it was a much larger structure. I mean, I could go on and on, but it wasn't, yes, they do impact investing. They have some great offerings, but my goal was not to go back into a big organization.
So you ended up at Tiedemann as part of an acquisition then?
That's correct. Yeah.
Okay. And then you brought Jed in?
Yes. I want to help us build more knowledge internally because the CEO was new to impact at the time. I thought, let's build an impact advisory board with people with deep knowledge so they can advise the board of directors, they can advise the C-suite. So it's not just me as head of impact, but it's, we've got some really deep expertise here. And so that's how I brought Jed in to the firm.
I had Jed on the show just a few episodes back. I think it was like episode 75. So anyone who's interested to know more can listen to that. He's been on the show twice. Jed's great. And he's been through it all from the very beginning. And he's full of life. Now let's talk about your current role and the move you made to becoming the CEO of Veris Wealth Partners. Tell me, how did that opportunity emerge? And what about Veris resonated with you personally? Was there any particular aspect of their approach that made you think, I need to be a part of this and I need to do it now?
There were a lot of things happening in my life at the time when I was at Tiedemann. My mother got sick and then passed away. So I took a break. I honestly didn't know what I was going to do next. And I recommend that to our listeners. Sometimes it's good to be lost, to just kind of take a break and talk to everyone in your network, or even just look at the clouds and read a good book. What I was sure of is that I'm very mission driven. I have all these different, aspirations around impact investing. A lot of the work around democratization, I still find fascinating. But the learning was I need to be in a fully mission aligned firm. And Tiedemann and a lot of my colleagues in the industry who are wonderful, they work within hybrid structures. So basically or even the big banks like a Goldman or UBS, they have an impact offering, but they themselves are not an impact firm. They're not a B Corp. They have their bread and butter offering, and then they have an impact offering for those who want. And that's a very different thing than having a firm that in its core believes that sustainable finance, the climate transition, racial and gender equity investing, all of those things should be core to your offering. And that's all you do. And so I looked around who in the investment space, I looked at both asset management and wealth management could be a home for me, which is really holistically dedicated to impact. And Veris has been since 2007. It was one of the first impact-only wealth management firms in the world, not just in the United States. And I knew there was a succession plan in the works. And the partners of Veris were very thoughtful. They basically planned succession, 2 to 3 years, well, actually a decade in advance, but the execution of it, like hiring the next person, is usually 2 to 3 years in advance. Anyway, so that's where I ended up finding a role as COO, which was not exactly playing to my strengths, but really I was a succession hire, and I've been there almost 6 years now.
So paint a picture for us of Veris today, for looking at the numbers and scope, the geographic reach, the team composition. What does that look like? And more importantly, what's the secret sauce that distinguishes Veris from other wealth management firms?
So, we're still boutique. We're in high growth mode, but we only manage about 2.3 something. It depends on the day, of course, because it has to do with, markets, but about $2.3 billion under management. There's about 300 clients, and we're moving more and more to institutional clients. So larger and larger clients that are foundations or large endowments. The secret sauce, I think, is the fact that it's 100% focused on impact. And so you have deep expertise around thematic investing. Depending on the advisor, different advisors have different expertise, some around gender lens investing, some around racial and gender equity, some around sustainable food systems. It really runs the gamut. And a lot of our competitors, they invest in oil and gas and they divest from oil and gas. So, a lot of what we do is there's no cognitive dissonance. So that appeals to a lot of clients, especially since we got reelected. There's a lot of, we lost the vote. How do we use financial capital as political capital around climate and around social justice? I would say it's our holistic approach that is our secret sauce and the deep thematic expertise. But we are small. And so, we're all eager to grow faster. And so the issue is, how do we grow to have greater impact while still building a sustainable and attractive and profitable business? Because we ourselves are an impact investment.
I want to talk a little bit more about Veris's mission, because I always try to get to the core motivation and purpose beyond the services you provide. So what's the deeper change that you're trying to create in the world through Veris's activities? What's the problem you're trying to solve, or theory of change? Because successful businesses that last are always solving meaningful problems. So maybe you could drill down a little more.
It's a very ambitious goal, which is to create a more sustainable, equitable, and just world. And so, of course, there is no panacea for that. But the way we go about it is through the lens of investing. So that means furthering the mission of our clients through investing in all asset classes, but also trying to change the world through not just how we invest and who we invest with, but also a lot more around policy and shareholder engagement. We don't flip it as what are the core problems? We look at it as to what is our vision for the just and equitable society we want to live in. But the problems have to do with climate change being an existential threat to humanity, and economic inequality and economic inequity in terms of access to opportunity. So, and this is very well documented, of course, but, looking at the inability for African American entrepreneurs and especially African American women to get access to capital. And these are all the problems, the undercapitalized communities. A lot of our investments are around addressing that need through our managers. But shareholder engagement is also a huge factor, because in public markets, that's where we feel we can have the greatest impact.
If we were to fast forward 20 years and Veris has been wildly successful, how would the world be different as a result?
Unfortunately, we have to get into politics here, because I'm also the chair of USIF, Investment Forum. The market, for us, what would be success beyond just Veris, because we do think of the entirety of the industry, is that the regulatory environment would be friendly to climate investors. So much greater disclosure requirements, so European type requirements on American companies, and also incentives to reduce carbon intensity and carbon emissions. That would already be an extraordinary success if that became the norm of any company. You have to track your carbon footprint, and you have to have a net zero goal by, 2050 or you said in 20 years. That would be incredible. But we're in a world where the opposite is happening. There's incredible deregulation, and in Europe as well as in the United States, and the US is far worse, where even the concept of climate is seen as a hoax, a happenstance, not man-made, not proven, etc. So we're headed towards greater human strife and environmental disaster. So I think that would be the core thing, we'd be in a world where climate is considered an existential risk and the regulatory bodies take it seriously for what it is. That would be huge.
You're only working within the US?
Yes. For now, we just serve clients whose assets are domiciled in the United States. Yes.
But do you make investments abroad?
Absolutely. Yeah, we do.
Let's step back a minute and just discuss, how does impact investing manifest differently in wealth management compared to other areas of financial services who do impact investing, say, I don't know, institutional investors or venture capital? And are there unique challenges or opportunities that come with the wealth management context?
That's an excellent question, because I think there are similarities in terms of impact management and measurement, whether it's in asset management or if you work within a foundation, a family office. If you're professional in banking is, I think, where we're lagging. There's not really an investment banking world in impact. The due diligence mechanism, the approach to measuring outcomes is more or less the same between asset managers and wealth managers. Where I do think it's different is that you're dealing with the total portfolio approach in wealth management. So it's harder because you're not just trying to measure impact in one sub asset class. You're trying to measure impact across all asset classes. So you can't really add apples and oranges, sort of. I'm trying to simplify it, but the outcome of investing in affordable housing, for real assets, or a venture capital firm where it's number of jobs created, or in public markets where you're looking at carbon intensity per dollar of revenue. Like, these are not things you add up. You can possibly add up. You can use UN SDGs to thematically say, here's dollar exposure to number whatever, in the oceans. But it's very hard in wealth management to aggregate impact. It truly is, I think, an Achilles heel versus in other sectors like writ large in asset management. The other difference is, this is true of any B Corp. You need to embed the DEI, the climate, and so on in everything that you do. And in wealth management, it means also in your due diligence of managers. So, and I know this goes against a lot of the executive orders of our president currently, but when you're a wealth manager who select you, so in our case, we don't pick stocks and bonds. We try to hire best in class managers across asset classes. You also have to apply, in our case, we do a DEI lens, a diversity, equity, and inclusion lens to each of the underlying managers, so that when you build a portfolio, you're not just saying, well, the underlying investments, have beneficiaries or end users who are diverse, but also the people you invest in these different strategies are diverse, or at least they seek diversity, and they themselves have due diligence in their investment process. I would say in the due diligence and how you conduct business, but also on the back end on the impact reporting, it is slightly different than your traditional, than I would say on the asset manager side. But in impact, we still don't have impact investing in all sectors of finance. So God only knows what that's going to look like in the future. When, for example, we don't have CPAs. The accounting world is not yet in the world of impact. The impact measurement is voluntary and done in-house by investment professionals. There's no auditing. So what does that look like in the future? I don't exactly know. There's also a lot of unknowns because a lot of the financial industry is still nascent to the world of impact.
What type of assets are you investing in?
So in all asset classes, except we don't touch crypto, we don't do commodities. We have, public equities, large cap, small cap, and, global exposure, fixed income, munis, private equity, venture, et cetera.
Are you doing direct investments and investing in funds?
Mostly funds, but sometimes at the client request, we do direct investing as well.
So primarily your go-to strategy is to invest through other funds. So let's talk about your clients a bit. What brings someone to Veris instead of a traditional wealth manager? And is there a common thread in their stories or in their values or maybe in their aspirations? What are they seeking that they can't find elsewhere?
They want the authenticity of a firm that doesn't just do impact investing, but it self-operates as an impact investment. So meaning that we apply our own due diligence lens around impact, around diversity, around equity, around climate. We ourselves are net zero. We ourselves are a B Corp. So most wealth management firms are not. Actually, 98, there are very few firms in our industry who are B Corps. So they want to be aligned with a firm that serves them, that has the same mission and also does policy advocacy, et cetera. So it's alignment, I guess, is really the thing. And they feel, because we're an independent, I mean, the other thing, but this hasn't to do so much with impact. We're an open architecture firm, so we don't push our own products. And most of our competitors absolutely do. I mean, they have their own investment funds that they push. So even if you fire the advisor, you're still a client of the fund for years to come. You can't unwind right away. We avoid conflicts of interest as much as possible so we can fire or hire managers. If you go, especially with the big bank, I mean, you are definitely at the mercy of their own products, which they have an incentive to push. But I would say it's the impact, the holistic impact approach. And also it's rare to have, a financial institution where the CEO is a woman, and we've always been women led, or majority women owned also, which is different.
You work with both individuals, high net worth individuals, and families, as well as foundations and endowments. How do those types of relationships differ, and what unique needs does each group bring to the table?
The foundations who come to us are really interested in the full, total portfolio activation, meaning full alignment. They come to us with, well, I have a traditional advisor, the performance wasn't great, or in some cases it was okay, it was fine. But it has nothing to do with our mission. And so we're doing all this great stuff with the 5% grant making every year at a minimum. And then the impact, the endowment is unexamined for that same mission, or it's just a carve out. So they come to us to do all of the endowment in impact. They know we can do that. We have many years of experience doing this. For the families, they come to us for traditional financial planning. So that's not having to do with impact. They need optimization. They need planners. We don't just have a suite of services around, just investment capabilities. We also accompany our clients through life events. We are a quarterback with their philanthropic advisors, with their accountants, with their lawyers, the trust and estate lawyers, et cetera. So there's we do a lot of traditional wealth management. It's just that the overlay is impact. And they come to us for both the investment acumen, the impact acumen, and then also the fact that we make their lives much simpler as a coordinator of a lot of their professional entourage.
How big is your team?
So we're 35 and we have 8 advisors.
And you've got a number of offices throughout America, right?
That's right. In San Francisco, in New York, Portsmouth, Denver. And then we have staff if, for whatever reason. We have one near Dallas. We have clients all over the country.
Walk me through your process. If I came to Veris tomorrow with my financial goals and some strong sustainability values, what would that journey with Veris look like? How do you translate someone's deeply held values into an actual investment strategy?
The guiding principle here is Delphi's know thyself. I mean, we really need in-depth discovery of the client to be able to develop an investment policy statement that meets the financial needs and the impact needs. So the beginning is really in-depth interviews and understanding also the history of the current portfolio where assets are custodied. I mean, a lot of it is also kind of mechanics of planning a transition, but a lot of it is interviewing, let's say if it's a committee, because we're working with a new foundation, it's the finance committee or it's the board. It all depends on the governance structure of the client. But we ask them, so what is your mission? Give us examples of grants. Have you done impact investments in the past? So it's really starting with their past and their mission and how that is translatable in an investable portfolio, and then testing the waters on what they would like to screen. So what things do you absolutely not want to touch? What industries? I mean, usually it's tobacco. I mean, the low-hanging fruit are tobacco, alcohol, guns, civilian and military and so on. But then it can go much more specific on certain issues, whether it's on certain sovereign states they want to avoid, or that they wish to double down on. So basically a lot of discovery, and then we codify this in an investment policy statement or an amendment to their current investment policy statement with the negative. So the screening, the tilting, so positively going towards an industry or a theme that they care most about. And then looking at the true thematic focus, meaning which investment managers and strategies, especially on the private placement side. So whether it's private equity or venture or private debt, would really further their goals. Once the investment policy statement is presented and discussed, then we move to a proposal. We test the water saying, well, these are different managers. How would you feel about this investment? And then it depends on whether we have discretion or not. And then we go ahead for execution and transition, which never happens overnight. I mean, unless you're handling cash, if we're dealing with assets and potentially many private placements, we also have to plan unwinding and et cetera. So there's a lot to consider for these transitions.
This approach that you take to understand what matters to the clients, is it highly structured, like questionnaires and things like that? Or is it more intuitive? What really happens behind the scenes on that?
It has to be very structured. Because much like my experience with Toniic or my experience building an impact investing platform with Threshold Group that then became Tiedemann, you need a process that is repeatable, scalable, that has checks and balances to make sure that no stone is left unturned. And I think that's the strength of an impact wealth management firm, is that the impact discovery is fully structured and part of the platform. It can't be intuitive, or else you can't also guarantee quality of service in the repeatability, for client number 315 versus 316.
Before you implement a strategy for a client, how do you ensure that it truly reflects what they want to achieve with their impact? And have there been moments where this process revealed surprising misalignments?
So absolutely. So the way to go about it is to present a proposal to see, and once again, it depends on the client. If it's a family, you're talking to the husband and wife, or if it's multi-generational, it's a family reunion, or it's a person, or it's a committee. The idea is to present a proposal and describe in detail the strategies. In my career, and not just at Veris, but this has happened also in my previous firm, what you often discover is difference of knowledge around how the impact is translated in an intervention. So this didn't happen at Veris, but, just showing, for example, a sustainable timber fund to a client who philosophically says, I don't want to cut down a single tree. And you say, well, no, wait a second. Actually, the way this fund works is you have underlying timber companies. The approach is a sustainable one, but you have to cut down trees because it's part of the process of these businesses and the revenue generation. And sometimes you're dealing with clients who are purists. There are different levels of sophistication because there's so many interventions and they're so complex. It takes a lot of partnering with the client to say, no, this is actually furthering your mission and this is how. And sometimes you have diverging opinions around whether it's the intervention itself. But the client is king. So if they don't wish to do it, at the end of the day, you don't do the sustainable timber fund. But I have seen discussions with clients where if it's not within their realm of specialization, they need more education partnership. And what I love about Veris is the approach is you have to empower and help and partner with the client, because the traditional wealth manager talking down to the client saying you don't need to understand, or there's the alphabet soup of acronyms you don't need to understand, or you may not have to understand these graphs. That doesn't work for us at all. So what really matters to us is that we get into the weeds with our clients as much as they need to help further their knowledge and control. It is their assets at the end of the day. So our goal is not to walk in and sound smarter than they are. The goal is partnership and education. And sometimes, especially for foundations, they are more knowledgeable on these themes than we are, because that's all they've been doing for 20 years in that foundation. So they can push us. So, these are wonderful dialogues too, around climate or around racial equity, or have you even met this manager, or have you heard of this fund? Sometimes we're like, no, introduce us. We'd love to hear more. We have both those types of clients.
Let's talk about impact measurement because it's such a crucial piece of this puzzle. When it comes to showing clients the impact that they're having, what does that reporting look like? What does the conversation look like? And what metrics or KPIs resonate most with people when they're trying to understand the impact that they're having?
Because this is really a neophyte world, the impact today, and this is not just for Veris, it's industry-wide, is reported by each of the managers you invest in. So there's a self-reporting issue, which in of itself is a problem. And so we get data from the managers on number of jobs created, on CO2 abatement, you name the topic, a number of entrepreneurs of a certain underrepresented category. And then we add anecdotal evidence. We ask managers for stories. And of course, what do clients care about? The stories. The data is usually eyes glaze over. It's hard to tell whether it's good or bad. These number of jobs were created, but how much should be expected at that level for a fund? It's third fund working in this region. There aren't really benchmarks on the impact side. So there are benchmarks for financial performance. When you do that, then, I think what really resonates with the clients is the stories. And so you helped XYZ, whatever, create this company. And here's the picture of the company and the story around the company. And this is how lives were changed. Of course, there's a lot of limitations with causation. If you are one of 80 investors, are you 1/80th of the impact of the fund? Like, the truth is a lot of paradigms and a lot of research around this and a lot of all sorts of articles around impact management that we try to be pragmatic. We report on the data that our managers give us. We share the stories. But at the end of the day, we don't fully know what the causation is. It's probably more correlation than anything else. And it's not audited. And so I try to be very, practical in how I describe the impact. And there's a lot of people in our sector who are inventing all sorts of stories and love to describe extraordinary impact and billions of dollars catalyzed thanks to this $1 million investment. And, most of the time what I've learned in my career is we don't know.
I can understand that it's the story, but then don't things get squishy at that point and you open the door for some creative storytelling by charlatans who might be in the market?
The stories of individual entrepreneurs or beneficiaries are actually the most verifiable because these are individuals you can go call, and it's actual pictures and a website of a company, and you can go visit it. And we've had clients visit, et cetera. Where it gets more dicey is the big numbers. It's the aggregation. In my experience, at least, it's the reverse.
Veris focuses on 4 impact themes. One is climate solutions, another is sustainable agriculture, and then there's racial and gender equity and community wealth building. How did you arrive at these 4 themes, and what was the journey to identifying these specific areas as your focus?
Well, it's mostly client driven. I would say we have expertise in those 4 themes, but as our clients have different themes, we evolve with them. And also sometimes we pull them, we drag them with us. For example, the racial equity investing world really has become more sophisticated in the last 3 years, which is why we developed our own frameworks around diversity, equity, inclusion, and belonging. And we've, led our clients to think a little bit differently. But I would say it's mostly client driven.
You've described these themes as interconnected challenges requiring an intersectional approach. Can you bring that to life with a real example of how these themes overlap?
Basically, climate and poverty are connected. Racial justice and climate are connected. And so, for example, not everybody suffers from climate change in the same way or pollution. And so if you're investing in frontier markets or in emerging markets, the population of India and the population of East Africa or West Africa are definitely not treated equally based on level of income. And so poorer populations will be disproportionately affected because the poorer populations might be living on the coast or they're much, much more dependent on agriculture. And so issues of mass migration, food insecurity, etc., is very much at the interplay of climate and poverty and economic development. And so when you're looking at investing in agriculture, this is true also in the United States, the socioeconomic strata of farmers is lower than urban or suburban families, and they will be disproportionately affected by climate. So it's looking at what the interplay is of investing around climate solutions and who is affected. I mean, I think this is where traditional financial reporting and financial analysis, or even when I look at like traditional macroeconomic studies from any banks, I mean, there's a lot of reporting on inflation. I mean, traditionally interest rates and unemployment, just traditional metrics, but not who is impacted. The big difference is on who will be primarily impacted by inflation, who will suffer the most. When you look at unemployment figures, break it down by demographic of gender and race. And you don't see that in traditional wealth management. In our quarterly reports, we look at that, and that's really important. And so when we talk of intersectionality, so for example, you have climate on one hand and you have community wealth building on another. And then if you put them together, we would call that climate justice. And so we have a framework that Raj Pradhananga, our chief investment officer, developed around climate justice. That's the theme that is intersectional. And you're seeing more and more of that in the industry, I'd say, the intersectionality piece.
I always learn the most from specific examples. Would you be able to walk us through an example or two of investments that you have made across these thematics? And I'd be particularly interested if you could give an example of an investment that's effectively addressing racial or gender inequality. I'm just interested in the mechanics of how it works.
So Impact America Fund is a fund that is focused mostly on racial justice. And it's a venture fund that invests in African American entrepreneurs whose underlying businesses are about hiring minorities. So the fund is an impact fund, but the underlying companies could be everything from investing in beauty parlors for African American entrepreneurs who otherwise don't have access to traditional banking services or funding in poor areas, yet they are pivotal to the economic development of a certain city or region, as well as employment. That's a venture investment that where the entrepreneur Keisha Cash has been kind of a star in the space. We've invested in a company called Apis and Heritage, which is more of an ESOP model. So it's basically helping employees buy out ownership of the company for which they're employed when the CEO or the owner basically has zero succession plan. And the reason this is a racial justice play or investment is because many of those employees are minorities, so African American, BIPOC population that is rather low income, and they've never owned truly an asset. So they don't own their houses, or they're renters, but they don't own property or real assets. And what this does, this ESOP model, financing the buyout of these companies, and it could be a small construction company, it could be all sorts of companies, creates wealth with the underlying employees who otherwise would never have access to wealth. But also what it does is that it provides an asset that they can leverage for a mortgage, other financial products, and it allows the employer to have an exit, to actually, get out when they don't have a succession plan. But what it does is that it's creating wealth in communities that would otherwise not have access to capital or not have access to a financial asset. And these are transformational investments.
That's interesting. Your impact report mentioned indigenous rights investments, that caught my eye. What's the backstory on that investment and what kind of outcomes are you seeing as a result?
So we have what is called CDFIs, Community Development Finance Institutions. So basically they're loan funds. These loan funds target specific populations. So we have a CDFI called OWISTA, which is focused on Indigenous Americans who are entrepreneurs who need loans. And so that also is transformational, but it's very targeted in its approach to Indigenous Americans.
But what kind of results are you achieving with that? What kind of outcome?
That's a great question. So the two other funds I mentioned are risk-adjusted market returns. So that's the expectation. For these loan funds, it's below market. So we're looking at, a 2 to 3% a note over a 2-year period. So not commensurate with the risk. Some clients love this. Some clients don't want to touch it. So it really depends on the goals, the impact and financial goals of the client.
But what about impact on the community in terms of an outcome, not necessarily financial?
We consider those impact first investments. But the bullseye, to come back to Jed, is the blended value. I'm to you about blended value, but is having those investments where there is no counter between impact and finance. The greater the impact, the greater the financial return. And so that the Apis and Heritage case is very much a blended value one.
Social investments are often quite challenging to make a return on them in the same way that you can, let's say, in the climate and environment space, which is more crowded as a vertical. How do you approach social investments where the financial case might be more challenging, but at the same time, the impact potential is quite substantial?
Well, actually, it depends. So in Europe, we talk about social investments, and I'm thinking more of like the Ronnie Cohen language that is much more concessionary, like the pay for success bonds. That definitely is not finance first. But in our view, there is no need for the trade-off. And that's why for us, it's important to be seen and understood as excellent as an investment shop and having excellent financial acumen so that we're looking for best in class investments, both from a financial return and an impact return. And then for those clients who wish to do, more impact first, like these loan funds, to also have that offering. We're very client led, or we're in service to the client. What matters is that we meet their needs. And sometimes they do want to go to places where there is no other access. So it's expensive. These loans are very expensive to originate or to issue. And so we will have those loan funds, like I mentioned, like Owista or other. But generally, we don't go in with that mentality of the trade-off.
Do you find that your clients gravitate towards certain themes? And how does that financial return versus impact conversation actually play out? Are clients willing to accept different returns for different impact categories?
It depends again on the client. I think the overarching theme when we did client surveys were really climate's always the number one. It's seen as intersectional. It impacts everything. If it is not curtailed, reaching the 2 degrees Celsius increase in temperatures or more, this could have catastrophic impacts on migratory flows, on democratic stability, sovereign state. All of that is already starting. Inflation, cost of food, famines, and you name it. So I think that is always the number one theme. But a lot of our clients, especially the families, they live off their investments. So we don't go in with that mentality of the trade-off most of the time.
You have something called the Veris Just Transition Framework. What is it? What inspired its creation, and how do you use that?
It has to do with what I mentioned before, the social justice piece, trying to build a more equitable world while also transitioning on climate. We were probably in our team inspired for different reasons. The concept is that having a transition to clean energy while allowing for the poor within the industrialized world, or the poor meaning in least developed countries or frontier markets, to not benefit from the economic development and the pollution that economic development necessitated or can necessitate, is considered unfair. At the global scale, this is coming back to all the COPs and these developing world countries asking for basically funding, huge amount of funding from Europe, the United States, and, the wealthiest countries to support their economic development. Because the reason why Europe is where it is today is because it had the ability to pollute. It had its industrial revolution. The same is true of China. The same is true of the United States or Canada or the UK. but we're asking countries in the world to cut emissions while still maintaining a certain level of economic development for the population. It is intrinsically considered unfair. So that is at the guiding principle level what's happening. But the just transition in the United States is much more focused on job retraining, et cetera, ensuring that when you, for example, you close a coal plant, you don't just say, well, that's great for the environment in the United States. And then the individuals who lost their jobs economically suffer from this. And then you basically are harming certain markets of the United States, of the American labor market, for the sake of the environment. That's not good either. That's not sustainable. And so the issue is, how do you transition to a clean economy while creating economic opportunity for all, while still forcibly you're going to have displacement of jobs and changes inexorably away from fossil fuels. But the idea is, how do you do that in an equitable way?
I've had wealth managers tell me that they struggle to find market rate opportunities that are at the intersection of climate and social equity. And they, like you, are looking for competitive market rate returns. Where are you finding that sweet spot? And are there particular sectors or deal structures that seem to be working especially well in that regard?
Well, yeah, I mean, there's energy retrofitting for low-income housing. There's all sorts of tech entrepreneurs who work around solar in poor communities. It's really looking at the interplay of climate solutions and technology in areas that are low income. That's, I think, where the bullseye is right now. And there'll be more and more opportunities, I think, in that arena. But you're right. This is still a nascent space. I mean, the whole sector, the train's left the station. Yes, it's trillions in the public equity side globally, but we're still growing and there's still solutions. When I started, there were no real ed tech solutions, and now it's a very well established market. So I can only imagine what interventions and businesses will live at that intersection, give it 2 years from now or 3 years from now, because it's a great need.
You recently became chair of US SIF's board of directors. And there's another acronym there, USIF, there's EuroSIF, and I'm not even sure I remember what SIF means anymore, Sustainable Investment Foundation. Forum, that's it.
Yeah, which is bizarre. It's for a trade association. I wouldn't call it a forum, but whatever.
So what inspired you to take on that leadership role? And now that you're in the position, what are your top priorities? And overall, for people maybe who aren't familiar with it, what impact is USIF creating in sustainable investment that people should know about?
I was on the board of SIF for a few years and then ran to be chair of the board, honestly, to meet the moment, because we are facing such headwinds in sustainable finance in the United States. I mean, from all directions, from regulators, from the SEC, from the House, from the White House. I never thought that you would have an anti-sustainable finance president. I mean, that's one of his platforms, that we are woke finance, et cetera. So for me, it was very important when unfortunately, I saw quite a few colleagues back out and say, I don't want to touch this right now. It's too much of a tense moment for sustainable finance in the United States. And there are too many lawsuits also against asset management firms who do sustainable finance, Vanguard and BlackRock and others who, in my world, they're not like bleeding heart sustainable investors, but they have done enough and they have deep enough pockets that they have become a target. And then the Fearless Fund lawsuit against an organization that does the support African-American female entrepreneurs. And so the idea is to support also our fabulous incoming CEO, Maria Latini, who's the new CEO of USIF, in really helping to support the membership. And the membership is mostly asset managers, policy, terminology. I mean, there's a lot of noise as to what is happening at the policy side. There's a lot of declarations, but they're not necessarily met with legislation or with changes to regulation. So a lot of it is educating journalists, educating our members, also a lot of education of individual professionals. So SIF is incredible at doing all these courses, really building the sector and standards in the industry. It's a convener as well. And so, the Sustainable Investment Forum is in June in Washington, D.C. We do a lot of policy advocacy work. So we bring asset owners to the Hill to meet with their representatives and senators to talk about the benefits of climate investing, that really it's about integrating this is a financial material risk. So climate is not an ideology. It's not a hoax. It's just a better way to invest. So a lot of what we're doing, I think, is very reasonable. It's not like we're not political on social issues. We're not pro-life or pro-choice. Like those are not the things that SIF really focuses on. It's much more around defending the position that climate should be integrated in sound financial analysis. I mean, it's not a lot to ask, I think, but in the context in which we find ourselves, even that is considered a brave stance, even though I think it's better for all investors.
You are European and you don't live there anymore. I presume you still have family there. I mean, I feel like I'm less knowledgeable about what's going on in the US because I haven't professionally really worked out whole lot there for quite a few years. You're sitting in America. How do you see the difference between this in Europe versus what's going on in the US?
I see deregulation in Europe, but I think the huge difference is that on average in Europe, whether it's my former colleagues or friends or family or whatnot, there's no fundamental questioning of the veracity of climate change. It is accepted as a fact. The question is, what do you do about it? There's all sorts of swings. And for example, in France, they banned plastic forks and knives in all cafeterias. And then yesterday they reversed that. So, I mean, there's a lot of issues around pendulum swinging in one direction and then back. Also, more deregulation around reporting in Europe, to not create unfair disadvantage for European businesses that have complained again and again about the cost of reporting around climate versus U.S. counterparts who now are not facing any reporting since the climate disclosure rule was struck down at the SEC. So there's differences, but the European market is well ahead of the U.S. when it comes to dealing with climate. And I think in the US, the push is going to have to come from asset owners and consumers. I mean, consumers want sustainable products, et cetera. It's almost like a good marketing tool to say you're sustainable. But to really enact change, you need more and more big pension funds and asset owners, large family offices, et cetera, to demand that of companies. Yeah, there's great difference, I would say, in awareness at the corporate and decision maker level between the United States and Europe. We lag behind, and the forces of change are going to be different. It's going to have to be bottoms up in the United States versus in Europe, it's top down.
If your thesis is that you don't really sacrifice returns with impact, then this is a better way to invest. So is the pushback in the US different from Europe because somehow we haven't made the case or demonstrated that it's a better way to invest? Because at the end of the day, you don't have to convince people to get high returns. Can we do a better job of demonstrating that this is a better way to invest? Not just because it's the right thing, but it's actually quantifiably and demonstrably a better way to invest.
I think that you hit the nail on the head. I think the issue is in performance while we are in a period of transition. The reason this is so complicated to prove is because, and this has to do with geopolitics, in 2022, when Russia invaded Ukraine and basically the price of oil increased substantially, investments in oil and gas in what has typically been an industry of divestment for the sustainable investment world did very well financially. So in the short term, the sustainable investment approach, basically moving away from fossil fuels was not a winning strategy. And so that was used and still is to this day, looking 3 years trailing at performance by saying, look, because we didn't invest in oil and gas, we missed alpha. So, we basically are underperforming. And the problem is that we are in a period of transition, and what may have been true in 2022 or may even be true today will not be true in 10 years from now. Also because if the governments who are in power do continue to just decide, you know what, we're going to burn fossil fuel as we always have, then we're really heading for something maybe akin to extinction. So I don't think we're going to head there because there's too much knowledge throughout the world that this is, and the proof of temperatures, at least there's proof that the world is warming. But we're tying a lot of importance to the financial performance of these last few years as anecdotal evidence that no, you shouldn't be investing with a sustainable lens because look, you don't outperform. But the take inherent to this approach is a long-term approach. And that's part of the argument, which is look at the next 10 years. We cannot continue to burn fossil fuels as we have. We cannot continue to pollute as we have. This will inexorably have to change, and it will. And it is with, electric cars and so on. And that will be reflected in financial performance. But the issue is when. So an issue of timing. So your point is the bullseye issue today to prove that performance overall and in the long term will be commensurate with expectations, basically, on the sustainable investment side. Even though historically that's not been the case, but we're going through tectonic change.
You've been in impact investing for over 2 decades, and you've witnessed a lot of its evolution from the early days to now. What shifts have surprised you most, and what developments would have seemed impossible when you first started? Because sometimes I think we don't appreciate how far we've come until we stop to look back a bit.
I think for me, the big surprise was the level of greenwashing. I mean, to the point where I had some good laughs because I never thought that I would see UBS, Goldman Sachs, or, other banks really trying to promote themselves as impact investors and so on. But that happened. And so I think for me, the eureka moment was I was in Amsterdam for the GIN conference in October, and I saw every possible investment firm represented, from AXA to all the European banks and so on. And I was shocked because once upon a time at GIN conferences and impact investing conferences, you'd only see the really small shops or the foundations, etc. And so for me, that meant that, we are here to stay. We're in the mainstream. We're in the main consciousness as a financial industry of asset owners. There's still a lot to do. There are issues around authenticity. It's been sad to see, a lot of asset managers back out from NZAM, the Net Zero Asset Manager Alliance, after some of the accusations of collusion. But regardless of how much the pendulum swings, the sector is here to stay. I think because it touches fundamental topics that people care about that cannot just be dealt with public policy and cannot just be dealt with grant money. It has to be the financial system too.
Stephanie, I've really enjoyed this, and I want to thank you. We've covered a lot of ground here today, and I appreciate you taking me through all this because I've learned a lot. So tell everyone what's the best way they can find out about all the great things you're doing at Veris, your websites and social media and all that good stuff.
Yeah, so we are at Veris, Veris, because there's another Veris, VerisWP.com. And we're on LinkedIn, Veris Wealth Partners. Of course, we're not on X, which we boycott, but we are on Blue Sky. Yeah, and so most of our news is available online.
What's the best way for people to contact you?
info at Veris, VerisWP.com.
Okay, everybody, go to VerisWP.com. Lots of good information there. And Stephanie, thanks again for coming on.
Thank you for your fabulous questions, Scott. Really appreciate it.
All right. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, SRI360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact. all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.